I made $5,190 with one simple ORB strategy. And look, most traders lose money with the opening range breakout because they're making one fatal mistake. But I'm going to show you exactly how to fix it in the next 15 minutes. Here's what we're gonna do. I'll show you the exact timing window where real money is made. I'm gonna walk you through 3 live trading examples and give you a step-by-step process that you can start using tomorrow morning. But first, here's why 95% of ORB traders stay broke. Here's a brutal truth about the ORB that nobody wants to tell you. Most people think opening range breakout means you just wait for the stock to break over the pre-market high, or you wait for it to break the first couple candles on a 1-minute chart, and then you just jump in. But that is wrong. It's dead wrong. What a lot of traders will do is try this strategy on a 1-minute chart and go really narrow in their time frames. And so what ends up happening is you get a lot of failed ORBs, and then you think that the pattern doesn't actually work. If you see something like HIMS yesterday, it had a piece of news out with the Canadian government, and you can see here that like you had a 1 candle, 2 candle, 3 candles, right? It took out the opening range breakout on the 1-minute chart, but then it just kind of kerplunked, right? And what traders are doing are missing like 2 huge components of this that they're not nailing. Number one, the smaller the time frame, the lower your probabilities will be. Meaning that if you're looking at something, say from a weekly time frame, it's a lot easier to see than it would be on a daily time frame. And if you were looking at something in a daily time frame, it's a lot easier to see than an hourly. And an hourly is a lot easier to see than a 5-minute. And a 5-minute's a lot easier to see than a 1-minute. The more narrow you go, the more chances you have to guess wrong because you're just playing on the penny by penny, minute by minute game. And so what ends up happening is you spike up, you ORB, and then boom, it kerplunks. And so traders are missing 2 things. Number one, they're going too narrow of a time frame, and so the ORBs fail. But the second part of this is the huge part, guys, that people always overlook. When you look and you do this setup, if you notice on HIMS, even though it had a PR out yesterday, the daily chart is kind of garbage, right? It's not something that's trending. It's not something that's an uptrend. It's not even something in a downtrend. It is literally stuck inside a range, right? Like if you look here at this box, you're right in the middle of the range. That's the worst spot to be in as a trader. As a trader, guys, it's very, very important that you're either hitting stocks and doing patterns when they're bouncing off support, or you're doing the momentum patterns, which an ORB is, when it is breaking out, and then you're doing the patterns here, right? So you either want to be doing them as you're clearing supply, or you want to be doing them as they come down into levels of demand. Like, for example, if you pop up and you pull back into the 9 EMA, right? You pull back into the 9 EMA, like those are levels of demand. So you have 2 aspects. You can do it at breakout or you can do it at support. But the worst part and where everybody messes up is that they do it in the middle. That's the penis in between us. That's like being in the back seat of your brother's Volkswagen. You're not left nut, you're not right nut, you're not shotgun, and you're definitely not in the driver's seat. You're literally right in the back, and that's the most uncomfortable place to be in the car. And so we don't want to do these type of PRs or ORBs when you're right smack dab in the middle. So daily chart, breakout, support, never in the middle. That's going to save you and increase your odds of a successful ORB from, say, something 30-40% to 60-70%. The daily chart is everything. We get our ideas from the daily chart. The big picture tells us what we should do. Then the intraday tells us how to apply it and execute with precision. What separates the 5% who make money from the 95% who don't comes down to these 3 things. Number one is the stock selection. You need to have stocks that are either breaking out or sitting on support. You can't just buy any stock The money is made in the preparation, and that means knowing which stocks are actually worth trading. Second part is the timing. And I'm not just talking about the first 15 minutes. I'm talking about a very specific window that most traders ignore. And then the third is the execution. Having a systematic approach to entries and exits, not just buy the breakout and hope. The key when you're doing these ORBs is to learn when it's too extended. What I find is that the distance between price and the VWAP is of the utmost importance. If you do an opening range breakout and the price is too far ahead of the VWAP, you're going to get chopped because price likes to gravitate towards VWAP always. And so what happens is if you buy too extended, it's going to ping pong back and forth before that level gets tightened up. And so you want to make sure that you have a tight range. For example, why doesn't a stock like Nvidia that had this awesome news out, right? Why doesn't it not follow through when it's clearly showing some level of opening range breakout? Well, if you look here between the price and the VWAP, it's just too extended. And so you end up kind of pulling back. Ideally, you have that pressure that's building up. And so it's just not going to work. Now, here's something that may surprise you. Beginners actually have a huge advantage with this strategy. And you know why? Number one, it's simple, but you don't have years of bad habits to unlearn. You don't have years of pain and losses and baggage that weighs on you every time you take a trade. You don't have that mentality in the back of your head that says like, man, I got to make my money back from this account or this trade or that trade. You're not carrying around all the baggage of failed attempts and failed dreams. This strategy, it works because it's simple, but simple doesn't mean easy. You're still going to have to work your ass off to master it. Trading is hard, and anyone who tells you otherwise is lying to you. Not because of the overall complications of the strategies, but the fact is that you still have to apply the strategies in real time when the pressure is on and money's on the line. My old mentor used to tell me something that I hold true to this day. You're not trading charts, Kunal. You are trading your hopes and dreams. Let me show you a little bit of what I mean. This is what a typical failed ORB trade is that most traders make. You get a stock that's got some news out. It looks hot. It's breaking out the all-time highs. It's a popular stock. Everybody's watching it. And you see that opening drive. And then what you do is you're waiting for that first consolidation, and then you're trying to, right, buy it as it breaks out. And it never does, and it fails, right? And so now you're sitting there thinking like, what the heck? I just jumped into this. Why does it immediately reverse and then the trader just gets stopped out? Does that sound familiar? Here's the same stock traded the right way. Let me show you here what I mean. Here's a typical failed ORB trade that most traders will make. They'll all make this mistake over and over. You get a stock that's got some news out. It builds out a little bit of a range at the open, and you take out that range. And so they jump in and they get all excited. Man, I finally got a piece of this Nvidia. Here we go. And immediately you get a death candle coming here and you're stopped out and you're thinking like, how the heck did that happen, right? How the heck did that happen? It looked so good. Well, there's a couple things happening here that we have to be mindful of. Number one, we talked about two things, the daily chart and then the distance between price and the VWAP, okay? The daily chart on this actually did look good. You were correct in putting this on the watch list. The daily chart is in breakout territory. It is an obvious nice trender and it's been leading the market. So when it has news out, it is important to put it on your watch list. But when you look at this, number one, it was a sloppy ORB. For an ORB, you need 3 sideways candles. And they should look like there's a lid on the name. So you want to make sure that it's not like one thing is kind of peeking over, the second thing is peeking over, and it's kind of like it's got little spikes everywhere. It should look clean, like you've actually built out a range. So you have two things here. Number one, it's not clean. And then number two, like look at the distance between price and the VWAP. If you can fit 2 of your thumbs on your chart between price and the VWAP, it's too loose. I know that's a little bit simplistic, but that's the easiest way to do it if you're on the run, right? 2 thumbs between price and VWAP, and you're in a good spot. So this is what a true one will look like, right? So when I look at the ORB, I want something like this. So if you look at this type of stock, right, Tesla has a piece of news out, you spike up here, and so you make a high. And then the next candle and the third candle, they're under that high. And they can test it too, but if they're under, that's fine because you want that opening price, right? The actual opening price to be the trigger. So you don't want the second candle to poke up, the third candle to poke up. We're not prairie dogging here, right? We need a clearly defined level to form, and then we can do it. So we got 1 candle, 2 candles, 3 candles, 4 candles, right? So on the fourth candle, you do it. Now look at the distance between price and VWAP here. It is $2, give or take. $2 on a $300 stock is 0.7%, but also, right, is it 2 thumbs or more? No, man, that's 1 thumb or less, right? And so it's tight enough too. So then what happens is like when this starts to break through, right, you're off to the races. And this was a home run trade for us. We did the options contracts on these, and they went nuts on this particular day. This is what a true ORB looks like. You need that lid on the top, and that's the difference. The difference between having a huge win of thousands of dollars versus taking a $500 or $1,000 loss. I discovered this strategy 15 years ago, but ignored it for a little bit of time because I could not get it right. And I thought this was just, something that was a pattern that failed a lot, right? But it wasn't. Once I understood the timing, then everything changed. And that's the key to everything. Daily chart, distance between price and VWAP, but then most importantly, right, you need an actual lid on the name. That's where the real money is made because you need to have clearly defined levels if you're going to be a good trader. I personally like lines in the sand where I say, hey, if it's over this, it's good. If it's under this, I leave it alone. That type of structure allows me to take some of the thinking out of the market and allows me to trade a lot more stress-free. The first thing that you need to understand, forget everything that you think you know about the opening range breakout. Most people think the opening range breakout is just when you see some type of consolidation at the open. They see a stock pop, they wait for a few candles, and then they buy the consolidation. That's dead wrong. The best opening range breakouts are going to happen in the first 15 to 20 minutes, but it is literally when it takes out the price of the open. It's not when you just get some random consolidation and then you take that out. You need a level to build at the open and then you take it out. But if you are just waiting at the open, which is considered the first hour of the trading day, and then you buy a consolidation, it's often going to fail. That's why you see a lot of times when you try to do the opening range breakout at 10 to 10:30, that they fail all the time because that's not the opening price and you're getting too much price action now. And so you're missing that volatility window. For example, I saw a bunch of traders put AMD on the watch list in my chat room yesterday. And when I was grading my students' trade, so one of the cool things about our 60-day boot camp is that, when you're paper trading or you start trading, we have an apparatus where you can upload your trades and a mentor like myself will grade your trades. And I saw multiple people do this yesterday while they were paper trading. So no sweat off their backs. It's a good learning lesson and it's just paper trading, right? That's why we do it. But one of the things I noticed was that I saw a couple people buy, right, as you broke this opening range. But this is a little bit different. See, this is not the actual opening range, right? Like this is the opening range. And so what they're doing is they're just buying the first consolidation. So what's wrong about this? Well, number one, the move started here, and so if you're buying it here, you're already extended, like you've missed a piece of the move, right? But the second part is it's not clean, like it doesn't pop up and then you just go sideways where there's a lid on it and then you take it out. That's a lot more clean, right? Like that's something that you can really depend on. Where this is like, okay, it popped up, it came down, and it popped up, and you're just buying a break of highs. Guys, a break of highs is not a breakout. A break of highs is not anything. It's not an opening range. It's not a breakout. It's nothing. Guys, just because a stock breaks a level of resistance does not mean that it's a breakout. A breakout means that you have multiple tests of resistance, you have a clearly defined level, and you have other tenets that go into it. Too many times people just draw a squiggly line on top of a stock and think that's the breakout. That's not the breakout. That's just a squiggly line. Now, here's how you identify this setup. So on June 9th, I had RKLB on my watch list as you had a beautiful trend on this. So you see how it's just holding its bone zone the whole time. So you got this beautiful trend on it, and it's coming off this dip, and you're starting to break out some levels of resistance. So my thinking is like, okay, if it can clear this 2930, it's a opportunity to potentially do an opening range breakout. So once I've identified this on the daily chart is something that I want to trade, now I'm waiting for my intraday play. And remember, we want daily chart and the distance between price and the VWAP to be tight. So you get the first candle that spikes up, it comes back the second candle, and then when you start to take it out here in this particular range, now you have yourself a really nice opportunity. You can see the VWAP is trailing higher. So at max, you're going to have, 50 to 60 cent risk. That's a good risk taking. I preempted the breakout just a tad, as I had a feeling this thing was going to go. But the thing for me is to really tighten up my risk because I can add a few more shares, right? So what I wanted to do was try to get this as close to the VWAP as possible. Just anticipate that ORB slightly, because if it didn't hold that VWAP, I could get out of the trade really, really easily. And then it's just a matter of scaling out. My particular flavor is on a stock like this, I'm going to scale out every 75 cents to $1, and it's just sell half, then sell a quarter, and then sell a quarter. And, I'm a piker. I'm an Indian guy. So, right, we're always going to take our money. I always leave a little bit on the table. It was unfortunate, Wouldn't it be so nice if we could just hold all our shares the whole way and make so much more money? But that's not realistic. I think you got to keep taking profits. ABC, always be taking profits. I think that's the easiest way to go about something like this when you do that. Now, going back to this, why would I want to preempt the trade a little bit by managing my risk? So the key to opening range breakouts is that you want to put your stop loss under the VWAP. So this is just a matter of reward to risk, right? So if I buy here at $30.20, my VWAP will be here at $29.50. So I've got a 70 cents risk, right? So if I want to buy 4,000 shares at 70 cents risk, 4,000 shares, I would have a $2,800 stop loss if I got stopped out. Guys, that is just way too aggressive, right? Like at that point, if I had a 70 cent risk on the trade, I probably could only do max maybe 1,000 shares, right? Like I like to keep my risk per trade under $1,000 for this type of trade. This is not like some epic once in a lifetime trade. This is a trade that shows up 10, 15, 20 times a day, and I'm going to pick 2 or 3 of these, right? And so I'm not all in on this setup. I'm not trying to do, this is not like some once in a year setup, like, when you short MSTR at the top or right, SMCI the day that explodes, like something like that shows up very rare. This is a setup that has high frequency. You want to be really mindful of where your stop loss is. And so, 4,000 shares, that's a $100,000 position. That's not like something so crazy. And if I bought it here, then I'm essentially going to have 1,000 shares max, right? And so I want to preempt it to lower my risk so I can increase my shares too, especially if the daily chart tells me that it's a go. So those are the small nuances of trading that is always going to be mindful. For me personally, like I don't like the risk more than, I would say 1% to max 2% of my account on a trade, right? But 2% of my account on a trade that would have to be for like the once a week or maybe even a once a month setup. Something that is so rare, right? Something that shows up only every blue moon. And so the reward is just so high that it would mean that I need to be taking a higher risk per trade on it, something that's $5,000 or $10,000 because it's a unique trade. But something like an ORB, I would say a majority of my ORBs, my risk on the trade is anywhere from $400 to $700 because it's something that shows up high in frequency. It's a scalp trade. You know, most of my ORBs, I'm scaling out of at least half my position within the next 5-minute candle. I've logged now thousands and thousands of ORBs, and almost every one, the second 5-minute candle, I'm selling off half, if not even another quarter, if the trade is good. So that's the basic framework. Now, let me show you how this plays out in different market conditions with some more real examples. Now, look, when the market conditions change, you have to have even tighter ORBs with better catalysts. And so, for example, like in today's market, you're seeing a lot of breakouts fail, right? So I've had, tons of people tell me the market's been crap the last couple of weeks, and I don't believe that's the case, but it does require a little bit more precision. So what you're seeing in today's market is like a lot of these kind of plays where you have like this, set type of breakout, and then they fail. And so what happens is like when you have this kind of action happening in the general market, your ORBs have to be like really, really tight. So if you go and see we had a couple stocks on our watch list, 3 stocks on our watch list, 2 of them were really clean and 1 of them wasn't. So I put this TMC on the watch list, right? So this was its opening range. And so you can see here, it kind of tested into the opening range and then it just failed. Why? Well, in today's market conditions, because things are actually failing a little bit more, we know from our previous talk that the distance between price and VWAP is too aggressive here. And in a market where not a lot of things are following through, this is just a recipe for failure. Most likely it's actually the short spot, right? So the ORB can actually be the short spot in some manner. But this is kind of what's happening right now. I had this other stock on the watch list, SBIT, right? SBIT had a very, very similar look. It gapped up. Look, Bitcoin is breaking out today. So I thought maybe MSTR, maybe coin, all of these things would ORB and break out, but the market's been a little bit crap. And so what's happening is you can see this is the opening range and it tests right into it. And then what happens? It actually breaks for 30, 40 cents and then it just goes through. Why? Look at the distance between price and VWAP, right? If you run a race before the start of a race, you're going to be tired and you're going to fail, right? And so you have to have a much, much better setup. Now, there was another stock that had a nice catalyst out on American Airlines. I believe this was earnings today. Look how tight this ORB was. So if you come in here, this 12, let's call that 1230, and the VWAP is here at 1220. Guys, that's 10 damn cents. Maybe 12. That's tight, right? And so what happens is when you have a market conditions that are a little bit more choppy, you need even a tighter risk on the ORBs because that's what creates explosion. And then what you can do is you can actually size in properly. Look, if your risk is, say you wanted to risk $1,000 on the trade and you have a 10-cent risk here, right? You can literally have 10,000 shares at a 10-cent stop loss. You're going to have $1,000 risk. You can have yourself a monster trade. If you had a 10-cent risk and you wanted to just have $100 risk per trade, you could still have 1,000 shares of this thing and really go. But if you're going in, right, and you're in this kind of market, right, you're going in and you're having an ORB where it's super loose, look what's going to happen. You buy here and your stop loss is $1 away. Actually, it's more than $1. It's $1.50 away. Think about that. $1.50 stop loss on this. How many shares can you have? If you had 300 shares, you'd be basically at $450. Let's round that up to 500. That's a lot for only 300 shares. That's only 30 30, 18 plus 18, 36, right? 4,600, $5,000 investment. You're going to risk $500? No, I want to put like 100 grand into something and risk $500, right? I want to have those tight stop losses. I think that really makes a big, big difference. And so the market conditions matter, but also like in a hot market, like sometimes this might even follow through like a little bit, right? But so we have to always make some adjustments as we go through this. There's a huge difference between the AAL and then this SBET. And so that's where I want you to always be thinking about this. And here's something that, most trading gurus won't tell you. The strategy doesn't work every day. If you're doing ORBs, you need to be in an uptrending market. So there's 4 different market cycles. You have accumulation, right? So the accumulation is the market cycle that comes after a bear market where you're just basing at lows. And then you have run-up phase. That's where we're at right now. The run-up phase is where you're in just your big bull market, right? But the thing is, that only goes for so long. So if you look at the QQQs, we're very extended on the QQQs now. And so we're getting into like a little bit of this tired phase, right? So if you look, there's a lot of volatility here, big volatility. And if you notice the size of the candles on the QQQs, they're getting smaller and smaller, right? So we're in a little bit of a tired market. So that leads to some distribution in the stock trading patterns. And so what happens during those phases is the ORBs, they don't work as good, right? If it worked every single day, everybody would be doing it. It does work, but you have to utilize it in the proper market cycles. And so in this market cycle right now, where we're like a little bit more extended and tired, we're not at the beginning of the bull, the patterns have to be a lot tighter. You need that 10, 20 cent risk, and you have to do a better job choosing your catalyst, meaning you want to focus in on stocks that have earnings and fresh news, not just like, hey, this random stock had a PR, and so this stock is related, and you're playing hot potato. In a really hot market, you see that, right? Like you'll see some car company go, and then somebody will find like some obscure car company, be like, this one could go because this one went. That will happen in a really hot market because it's just a game of hot potato. When the market gets a little bit more tired, everything has to be precise, and the catalysts actually have to be a little bit better. I'll do another video on some catalysts and how to read through them, but just always be mindful. There are days where you don't have to trade this strategy. If the market is showing signs of distribution or just a little bit tired, right, then you have to just lay off. And of course, if you have like major news events where you could get a lot of fugazis or fake outs, maybe it's a holiday day, like it's the day before Thanksgiving, then be mindful that you want to trade a little bit smaller size, but you may get some fake outs too. And then you can wait for those better conditions. Remember what I always say, the money is made in the preparation. Every morning before the market opens, I'm scanning for stocks, but I'm also doing a considerable amount of homework at night so that when I wake up, I'm not just like running amok. So look, I've just given you a strategy that can make you potentially thousands of dollars per day. But here's the reality. Most of you watching this won't do anything with it. You'll watch some videos, maybe you'll take some notes, you get excited for a few days, and then you just go back to doing whatever you were doing. I mean, that's just pure human nature. The difference between knowing something and actually implementing it successfully is huge. It's the difference between watching someone play piano and actually being able to tickle those ivories yourself. That's why my team and I offer a personalized strategy session where we can look at your specific situation, your account size, your goals, and create a custom plan for turning you into a consistent trader. Guys, I have been doing this literally my whole adult life. If you're serious about taking your trading to the next level, I want you to schedule a call with my team. We'll spend 30 minutes going through your current trading approach. I'll help you identify what's holding you back. But here's the thing, we only do a limited amount of these calls each week because we actually care about providing real results. I know everybody says that, but look, I teach my classes live. These aren't on-demand seminars. I don't just hop in and send people videos. I personally teach all my classes, answer the questions, do the homework. So I keep it real limited because it's my bandwidth. Once you book a call, you're gonna get access to our free trading community so you can just see what we do and watch the maestro tickle those ivories himself, where you're gonna be getting results like I've shown you, and I'm gonna show you and walk you through what I do. I promise you, you're gonna get more value in my free course than you'll probably get in any other paid course. Guys, the link is in the description. I'll see you on the inside.